Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Gemini Real Estate Advisors LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling and Sterling, Stephen Napolitano, The Wickoff Group, Urban American.
So, there is this perception out there that the economy has turned around. Happy days are here again for real estate. But I still say when you have gas over $100 a barrel, when the food cart guy increased his expenses by 25 cents and on this, and Pampers have gone up, things aren't really that great. So today I brought 4 individuals in their 30s, 4 people to provide their perspective who've been involved with real estate since they started during good times and bad times to see their perception of the times today. My guest today includes Scott Berman, who's a principal at the Engel Berman Group, Martin Nussbaum, who's the president at Silverstone Property Management, Dan Shields, who's the administrative vice president at M&T Bank, and last but not least, a returnee, my friend Josh Zegan, who's the co-founder and managing principal at Madison Realty Capital. So for the other point of view, I have a 32, I have a 34, I have a 39, and I have a 35. But you'll be 36 soon. But so I have this over here. You got into the business when the world was pretty good. And then you saw the world really go good. That if you were an idiot, you could make money in the real estate business, right? I'm not saying you. I'm not, that wasn't brought to you. I was talking about some of the people because you lent money to these people. How do you see the market today?
Well, I think over the last, I'd say, 18 months, we started to see some transactions, I would say, going into 2010. And I would say the last 6 months, transactions have picked up a great deal, especially in the New York metro area, because the bid-ask spread has narrowed. Banks have started lending, and as banks started to earn their way out of some of the problems, they were willing to take some discounts on loan sales. So we've seen a lot more transactions in the sense that buyers are willing to buy back some of their debt positions, and banks are actually willing to sell some of those positions. And that's created a lot of momentum. But in addition to that, New York, transactions have never completely stopped because in certain areas, especially in multifamily lending, banks were always lending on smaller kind of transactions.
What a perfect way to lead into the banker. So here is the banker. Here's he's even more. He's a banker. He's an attorney. He's there. You've been on the market, and your bank has been lending all these years.
Absolutely. We never stopped lending. We slowed down only because the demand slowed in 08 and 09. We've been in an all-out sprint really since early summer of last year. It continues today. We have, I don't want to say more business than we can handle, but we're certainly at capacity or close to it.
So what are you seeing? I mean, who's borrowing? Is it, are the banks loosened up their credit, or are you lending money? I mean, who would you lend to? Mr. Berman?
I do lend
Mr. Nussbaum? I mean, would you? I mean, who? How are you making decisions? And what assets do you like? And what do you see out there?
We've always, as a bank, M&T's always been focused on the sponsorship. So we look first and foremost at who wants to borrow our money. We would sooner lend on a mediocre transaction with superior sponsorship than we would on a fantastic deal, fantastic property with mediocre sponsorship. So we spend a lot of time getting to know who we're lending it to, who we're lending our money to. And if they pass that sniff test, then we open the vault.
Here's a question. I mean, over the years, I've had many people on the show, and I remember one of the people by the name of Norman Sterner, a very bright guy who's been in business close to 50 years, and I brought up the terminology called recourse. And Norman said, that is a word that left my dictionary. Guarantee, recourse? How do you look at a borrower today? I mean, multifamily is a different perception, but what about recourse and guarantees?
We like them. I think there's some statistical data that'll support that a guarantee doesn't get you any more money back if you have a default, but it probably stops the default from happening. So we see recourse really in two ways. With certain customers, they're providing principal guarantees, completion guarantees, debt service guarantees, and then there is the level of sponsorship where their reputation is really where the recourse comes in. So we know there are a handful of premier New York family type developers and investors that there's no sum of money that's going to allow them to damage and tarnish their reputation. And for those types of investors, we don't necessarily require recourse.
Before I get to Martin and Scott, I know you lend. Madison is in the lending business. What about recourse? Guarantees, situation.
Yeah, we in many cases get guarantees, but at the same time, from our perspective, the asset really comes first. Typically, we're looking for income-producing properties.
So you don't mind taking over the property.
Exactly.
You give me the bricks and mortar.
One of the big parts of our business was we built really a vertically integrated business which had both debt and equity expertise. So from our perspective, we lend in the middle market, but we also look at the asset first and borrower second. So if I'm in at 65% on average of value, if the borrower defaults, I'm in still at a good basis. And that sort of, I think, kept us in a good position during the downturn because our average portfolio was around that 65% of value. And in New York, typically the basis didn't come down below that, except in certain areas like the office market.
Right, and I think a very good example, because it recently hit the real deal, that you had made a loan on a property on 86th Street, a really great building, and your loan was for like $7.5 million. Terrible borrower. I mean, you'd never looked at the character over there. And the building went to auction because it went into the bankruptcy court, and the building went to auction for $20 million. So you got your $7.5 million, plus you got another $3.5 million in interest in default. So
That's right.
Going at the asset, it really was a great transaction because you looked at the bricks and mortar and you said a building on 86th Street between Columbus and Amsterdam is a great deal.
But I would say, just to add to that, we don't sacrifice in terms of due diligence in the sense that we would do background checks and everything else like that. So I want to make sure I'm getting in bed with the right, not the wrong people.
So you mean you'd lend to somebody like him?
Right.
So you'd lend to him. So, man who likes to own multifamily, what's happening? Tell us. What do you see out there?
We spent about a year looking at the market, waiting for transactions to materialize, and also the markets were very unsteady for a while in 2009. I think in 2010 we started to see some stability, and we focused particularly in very primary strong markets, Manhattan and the better parts of Brooklyn from our perspective. And
I mean, come on. Lower East Side was not a prime market, but now it's a prime market. I mean, Alphabet City was not something that people would want, but I mean, even Bremen would live there. You know?
I mean, I think, we there, from our perspective, when we're looking at Manhattan, there are very few parts of Manhattan that are poor. It's a matter of how one submarket's better than the next. We believe heavily in the Lower East Side. We've bought a couple of buildings.
I like
there.
it. I just have to kibitz a little bit.
I will tell you though that the retail in Lower East Side, I think, is not doing as well as what we anticipated it to do. But on the flip side of it, the residential side of it has been unbelievable. And so, we're pretty bullish right now on the multifamily market in general. We're seeing rental rates increase tremendously from 12 months ago, and we're continuing to look at.
And you're seeing, as we were talking before, you're also seeing, besides rental rates going up there, you don't have to pay the brokerage commission like you had to pay before. You don't have to give a 1 month's free rent. I mean,
we were talking before about an example where a year and a half ago, maybe 14 months ago, and on the same unit, we were offering a month free and probably 10% less rent than we're offering today. So on a net effective basis, I think we're seeing increases of 20 to 25%, from 12 months ago. And I think what we're seeing going forward is a continued increase on the rental side for apartments. But I also think it depends on what you're delivering to the end user. I think we really try hard to fit each submarket to what we think the end user is going to look for and want to try and achieve the highest dollar amount.
And that relates so perfect to Mr. Berman. I mean, Mr. Berman has the Engel Berman Group has a lot of different things. They own office buildings, they own development sites, they own active adult communities, which are 55 older. And then, because he really needs it, they are the premier owners of assisted living facilities. So, as opposed to and you're looking, but that's really a major business. That's a business that those customers, where your average age is what?
83.
83, and they're paying high rents. What are they paying?
Very high rents. Starts anywhere from $3,700 and goes up to over $7,000 a month for a 2-bedroom apartment.
And that market, what's happening there to you?
It's a very robust market. It's very much need-driven, so people who are there to a certain extent have to be there. So our occupancy rates have stayed very high. It's somewhat recession-proof. And there's a tremendous demand for it in our market in Long Island. And we're expanding to other similar markets.
Aren't you going to New Jersey?
We're
So
going
you can
to
be
New
near
Jersey,
Shields
we're going
over
to
there?
Westchester. So we're expanding. We plan to build 10 or 11 facilities in the next 4 to 5 years.
But you're also, you did something called the Aqua in Long Beach,
We did.
I mean, that wasn't an assisted living, that was...
Very high-end condo, probably the most high-end condo ever built on Long Island. We like that product too.
How large were the units over there?
They're 2,000 to 3,000 feet, and they're selling in the $2 million range.
And then there's another diverse side of you, the auction business.
The auction
I mean, what are you, becoming the auctioneer? So tell us a little bit about that.
The auction business is something I learned about actually as a principal, looking for an aggressive way to market and sell real estate. We built a project called Ocean Grand in the Rockaways. We had about 20 units that we needed to sell, and we wanted to sell quickly, move on to the next project. So we retained an auction company and sold them all in one day. And I was mesmerized by the whole process. The guy who ran the program for me is actually a guy I went to college with. A couple of years ago, he was ready to make a move, so we partnered and formed Paramount Realty USA, and we've been very successful.
So what do you, we were talking before, and this relates, Josh, we heard his thoughts, with looking at the asset. How do you look at, as a banker, a decision, you have a Scott over here, who has established company with his dad and other people have been in the business, and they're a good credit. They're also they're a depositor at your bank. How do you make a decision if you want to lend to somebody like Nussbaum over here? I mean, or Zegan? I mean, how do you? I mean, the character question. Oh God, one down. But what about the other situation? How do you look at I only like these guys, but I'm saying, when somebody comes in there, how do you make that determination?
We spent a lot of time talking to people, checking out reputations, making sure that things check out. We do an equal, maybe greater, spend a greater amount of time investigating. Once we get over that hurdle, investigating the project. If they're putting their cash in the deal, significant amount of cash, that helps certainly. If it's not just about the bank buying into the deal, the developer has to really be invested in it as well.
Here's a question, and I think Josh and Martin, I think all of you, when we were meeting in the green room before, brought out this concept. Do you think we are truly in a recovery, or do you think, I'm looking at everyone, I'm not looking at Dan or Josh or Martin or Scott on this. Do you think we can have a double dip? Do you think certain of the markets, I'm not talking about Pittsburgh, I'm not talking about other places, I'm talking the metro New York area. Do you think things are that good? Or what's your real thoughts? Because you came into this market, as I said before, you came in when the world was getting better, and then we had the plop, and that plop was, when I used to have office brokers, or even my friend Ophir Denny, it was a different world. But the worlds can change. You haven't seen all these ups and downs like I have. Scott?
Yeah, well, I actually don't think there's going to be a double dip. I think it's just going to be a very slow recovery. And we did come into the business in a time where we saw unbelievable appreciation in the real estate business. So much so that we probably saw 30, 40 years worth of appreciation in a period of 10 or 15 years. There's a lot of distress right now, I think, that people are taking advantage of. We're buying notes, and we're out in the market, we're buying land at very aggressive prices. So there's a lot of opportunity in the market because there's so much distress that's slowly filtering its way through, all these bad loans and et cetera.
Martin?
I agree. I think that I don't see a huge opportunity for massive appreciation, but I think that we're very comfortable with the idea that the market's stable. Could there be a quarter where things drop slightly? That's something we've discussed, but we don't think that there's any sort of opportunity, sort of massive, problem. And I think generally what's making us much more comfortable is I think the banks are a little bit healthier, and I think that a lot of the panic is out of the market, and we're hopeful that leads to more stability and the banks opening up a little bit more, and continuing to allow us to borrow money at reasonable terms. We're not borrowing money at 90,
You have 3
95.
children. We're only taking 2. It's no longer the firstborn and the.
No, but it's really, to me, it's if the lending, a lot of it comes down to lending, and a lot of it comes down to equity interest. And we were talking earlier, I'm seeing a significant amount more since the beginning of this year of equity funds, equity investors, really interested in investing in real estate, particularly in primary markets, and at lower returns than what they were seeing before, which I think is important because it kind of sets parameters a little more realistically. We don't have to go into deals at all looking to turn 20% of the rent stabilized units out. We go into every property saying we are going to get no rent regulated units out. We're just going to go and add value in other ways. And just off of that basis alone, we're comfortable making this investment.
What about, I was bringing up before the show, I was talking about the inability of younger people, there'll be more renting than buying because of the economy. You had brought up you were saying about some of your friends.
We sit around once in a while with, my friends all in the same plus minus age group, and a lot of people are more interested right now, at least for the next year or two, in renting than buying. I think because the question is, or do you think you're buying at a good time? And from the condo side, it's not something I'm heavily involved in, but I'm obviously following it. The volume isn't quite there anymore. I think the prices have held pretty consistently over the last 6 to 12 months, but getting a loan from the banks has become a lot more difficult. And then on top of that, there's an opportunity where no one is really sure if the condo market may drop another 5 or 10%, or stay where it is and start increasing.
What do you think about that, Josh?
Well, I just think from our perspective, we think one of the biggest risks to the system overall is just interest rate risk. Given that inflation is coming, we don't know when it's coming exactly, but we think that rates are going to rise, and there's a lot of deals getting done at sort of artificially low cap rates today. So because of that, there's real refinancing risk in the next couple of years.
I think you bring up a great point. We were talking, LIBOR has been at these prices which we've never seen in years. They're maintaining. They've been at a quarter. Prime is 3 3/4, and it's been this for over a year and a half, maybe
2
years. And I unfortunately I remember the 80s and 90s when prime went up to 20%. I mean, I don't see that situation. But I do believe, and I've told the story, you were there yesterday, about the coffee wagon in front of our office building, where they put a sign in the window that they imposed a 25-cent surcharge on every item in the coffee wagon. And you have children, young children. I noticed in the paper that they said that Pampers are going up by 7%. And
I'm more worried about tuition going up by that amount.
Tuition,
Pampers I'm okay with right now. Tuition's a bigger concern.
No, but all of these things have an effect, and I think what Josh just brought up, and at the banking situation, the artificial number. I mean, deals make sense when you're paying 4.5%, 5%. Martin could buy a building, or Scott could develop, at a certain number. But if the rates go up to these high levels, this could really have an effect, because it had this effect in the opposite effect. You had these 5-year loans which had a recast number at a certain level, at a floor, and then the rates were below the floor, and many of the banks just wanted to keep the loans, so they did that.
It certainly saved a lot of banks. That floating rate debt was paying 2%, 3% on projects that were otherwise suffering. I know that when we originate new product, we sensitize our underwriting to more realistic longer term rates. So we're not, even if the rate is going out, the coupon's being struck at 5%, we're looking at 6+%, 7+%.
So you're protecting the risk.
So we're protecting the risk. Plus the leverage is low enough today.
I hear multifamily from this conversation. What's your thought about? But Martin brought up a good point that even now in the Lower East Side, where the residential is doing great, the retail is not doing that great. I know you built a Stop and Shop.
Stop and Shop.
But hey, Stop and Shop is a great supermarket.
Great supermarket,
but you know what?
great credit tenant.
Great tenant, but look at Pathmark, and A&P went completely out of business. Yep. So it's a tough market over there. What's your thought about retail?
Well, what we're seeing overall is, New York is a different sort of animal, because you're seeing pricing, 666 Fifth just sold for some crazy number.
But that's a special
right.
market, because Martin was bringing up before the fact that he lives on the Upper East Side, and there are so many vacant stores on 1st, 2nd, and 3rd
Right.
Avenue.
So excluding that, throughout the country, there was a huge gap in terms of spreads for cap rates for retail throughout last year. Some of the spreads are starting to narrow because the securitization market has opened to some extent. So this year they'll probably do about $50 billion in securitization transactions.
As opposed to $11 billion last year, as opposed to $2.7 billion the year before.
Right, so that's a huge change, because that was driving a lot of the retail, some of which is in secondary kind of locations. In a place like Brooklyn is under-retailed in general. So
urban retailing is urban New York City retail in 3 boroughs is fine. Staten Island may be a difference. In the Bronx, it's really, there are affordable complexes in the Bronx that they still can't get $15 a square foot to rent over there on that market. It's a different case.
I mean, there's certain markets where just retail it's over-retailed. Texas, you drive in Texas and you see just tons of vacant retail.
There's no zoning. You can do whatever you want. What about, your family has the roots in industrial. How do you see industrial?
Industrial in Long Island has gotten more and more difficult, especially in Nassau County. I mean, tax rates are through the roof. It's very, very difficult to make industrial deals work, pencil out. We have a stock of antiquated buildings with low ceiling heights and structural issues, and it's really most industrial users are leaving Long Island.
But you have a bigger situation in Nassau County. The taxes could kill you. I mean, in certain cases, office building rents, the rents are reasonable, the real estate taxes are unreasonable.
Taxes are through the roof, LIPA bills are through the roof, expenses. Owning real estate on Long Island is becoming more and more difficult.
What about New Jersey? You live in New Jersey. I mean, you don't lend really in New Jersey because you have my friend over there who runs the Jersey region of M&T. But how do you see the Jersey market?
I mean, it's slower. It just is it's the investments, the money available for investment is coming into the big gateway cities in the country. So they're coming into New York, they're coming into Washington, San Francisco, a little bit of Chicago and LA, but it's not interested in taking the chance on some of these other markets.
I don't want to be in Tenafly. They said, it's not my neighborhood that
on my backyard.
But when you talk about going into Jersey City and Hoboken, it's a different world. I mean, Hudson County still has the higher rents and the situation over there, than in other parts.
They're certainly suburbs of New York City, extensions of New York City.
They are the six boroughs, I would say. They're over there. You were talking about Williamsburg. What do you think is the next Williamsburg? Because that's already doing well.
We've invested. We actually just bought a development site in Williamsburg, but I think Williamsburg's expensive already. I think the market's already there. It's maturing, and it's going to mature quickly. For us, the next market we're looking at is Bushwick. From a retail perspective, there's very limited stuff there, but a nightlife perspective, it's already started to pick up significantly. So I think that the people who are being pushed out of Williamsburg, the hipsters, as everyone calls them, who are being pushed out of the market.
You're too old now.
I know.
I mean,
if it were a 25-year-old age, then we wouldn't be able to say that.
That's right. But here's a quick thing. You went to Rockaway, and I saw there was on the plans that John Catsimatidis is thinking of building. And they approved in Coney Island. Do you see Coney Island as a space for the Engel Berman Group?
Coney Island, we haven't looked in Coney Island, but sure, there's potential there. Why not?
So I'd like to thank my 4 under 40 today. I'd like to thank Scott Berman, Martin Nussbaum, Dan Shields, and Josh Zegan. And see you next week.
Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling & Sterling, Stephen Napolitano, The Wickoff Group, Urban American.